Lots of generic and common questions about stocks and ETFs can be answered by better understanding ETF norms. In other words, this concerns normal characteristics and considerations within the stock market. Things such as what is normal performance of the stock market, along with the relative position of traders and investors during dynamic market conditions. The key to understanding most all questions is to understand baselines of average market performance. In order to do this, large liquid ETFs representing major stock market sectors provide a versatile and general tool. Such ETFs can reveal what is normal performance within the stock market and individual sectors within a given period of time. Then it is also important not to get locked within a single mindset regarding ETFs or stocks for that matter. ETFs can be used to varying degrees and combined with stocks, in addition to other assets such as real estate, resources, currencies, and bonds. So is there an ETF for everyone? Answer: yes, probably, and let's see. The following ETF examples will consist of several key features. First of all, they'll comprise of tens, hundreds, or even thousands of stocks and assets. They have high liquidity, and as you know, this allows for fast order fills at more favorable prices for buyers and sellers, making these a good starting point for beginners and a useful tool for more experienced market participants. Needless to say, these are not recommendations to buy or sell any particular ETFs or assets for that matter. These are strictly for demonstrative purposes of the ETF and the market concepts discussed. These ETFs have the features we discussed earlier, making them a good starting example. The name of each ETF is listed along with what it represents and their ticker symbols, beginning with the Dow Jones Industrial Average ETF, ticker symbol DIA. The Dow is among one of the first modern stock indices. It is an index tracking the 30 largest companies on the American stock market. The SPY or SPY ETF tracks the S&P 500 index. This index tracks the stocks of 500 large companies listed on the American stock market. In general, it has similar movements to the Dow and the Dow ETF. However, there are some slight variations, of course, and some would say that since the S&P 500 tracks 500 as opposed to 30 stocks, it is an overall better representation for the broad stock market. Then there is the QQQ, which tracks the Nasdaq index, and this index does represent the broad stock market similar to the Dow and S&P 500. However, it is more tech-oriented. Then there is IWM, tracking the Russell 2000 index. This also gives an overall representation of the stock market like the other three index ETFs. However, like the name suggests, it is an index that tracks 2,000 smaller companies, and this gives a better representation of companies that don't quite have the resources of large cap companies, most commonly found in the first three ETFs. But overall, these first four ETFs are broad representations of the overall stock market and are a good baseline to see what is normal in the market at any given time. Then you will see a group of four more ETFs below: XLY, XLK, XLI, and XLF, followed by XLV, an ETF tracking the healthcare sector. Below that, there is XLB and XLP, followed by the pair of XLE and XLU. You will see shortly why those ETFs are grouped the way they are, because ETFs have a varying degree of correlation to one another, especially in terms of these broad stock market sectors. Additionally, keep in mind these are American stocks and ETFs on the American stock market. However, they are often very accessible to regions outside the United States, and these concepts discussed are generally applicable to other regions of the world. But there will of course be some variation from region to region, especially for stock markets in places where the economy relies more on resources and finance. So in some stock markets, there will be a greater correlation between the energy and financial sectors at certain times to the broader stock market in comparison to the American stock market. A quick note to remember, correlation doesn't equal causation. It is just a relationship and connection between these ETFs, meaning that a higher number closer to 1 will be a stronger correlation. That will mean there is more influence, both directly and indirectly, between ETFs. Here is the correlation table between the stock market sectors and the broad stock market, represented by the SPY S&P 500 ETF. Like everything else in the stock market, correlations are dynamic, but the strength of relationships between these sectors and the broader stock market is generally within the 0.10 range from year to year. I have conveniently color-coded this correlation table so that 1 represents a strong correlation in red, followed by orange, a strong correlation but slightly weaker, followed by yellow, and eventually a blue color with a much weaker correlation closer to 0.4 or 0.5. You can find lots of combinations of correlation here. However, we'll cover a few key features that were highlighted in the previous diagram. For this demonstration, focus on the bottom row, and we will see some correlations to the broader stock market. Immediately, you will notice that XLY, XLF, XLI, and XLK have the highest correlations to the SPY, the broad stock market. Recall that earlier, these 4 sectors were grouped together in the light blue: industrial, financial, consumer discretionary, and technology. This means these 4 ETFs, and therefore these stock market sectors, are most closely connected to the broader stock market. They will very closely approximate the movement of the broader stock market, represented by the SPY ETF. Then there is XLV, which is by itself, because in general, if we go back to the correlation table, go to the bottom row with SPY, then line it up with the XLV healthcare sector ETF column, there is a correlation of 0.86. It is quite strong, but slightly weaker than the previous 4 ETFs, meaning that overall the healthcare sector will closely approximate the broader stock market and those 4 previous ETFs, however, to a slightly lower degree. Next, there is XLB, the material sector ETF, and XLP, the consumer staples sector ETF. Go back to the correlation table, bottom row with SPY, line it up with XLB and the XLP column, and you see that the correlations drop off slightly. XLB with 0.85 and XLP with 0.88. These are still quite strong, but they begin to weaken. Lastly, there is the most drastic difference, with XLE lowering to 0.72 and XLU going all the way down to about a 0.56 correlation, a very weak correlation in comparison to all the other ETFs with the broader stock market. This means the energy and utility sectors are not always completely aligned with the exact same movements as the other ETFs and the broader stock market. They can deviate quite significantly. Remember, these are correlations based on historic averages, and they may hold up over time. However, there can be variation from year to year in the stock market, as we will soon see in examples showing the charts of these ETFs.